This presentation is designed to help you prepare for the MLO SAFE Test, a key exam for mortgage loan officers. We will walk through the essential topics, tips, and strategies to ensure you're well equipped to pass the exam with confidence. Whether you are new to the industry or looking to brush up on your knowledge, this guide will provide valuable insights and resources to help you succeed. Let's dive into the core concepts and important details of the MLO SAFE Test. Slide 1, Appraisals Overview. Alright, let's dive into appraisals. An appraisal is basically an expert's estimate of how much a property is worth. There are three main methods appraisers use to figure this out: the sales comparison approach, the income approach, and the cost approach. Each method has its own way of looking at the property, and sometimes appraisers use more than one to get the most accurate value. The sales comparison approach is probably the most common method. Here's how it works. The appraiser looks at three similar properties, called comps, that have sold recently, usually within the last 6 months and within a mile of the property being appraised. They then adjust the prices of these comps based on differences like lot size, views, whether there's a basement, and the condition of the property. There are some rules about how much they can adjust, though. The total adjustments shouldn't be more than 25% of the comp's value, and no single adjustment should be more than 10%. Sometimes, you might not need a full appraisal. For example, if you're dealing with Fannie Mae, FNMA, they have something called Automated Collateral Evaluation, ACE, which can waive the need for a property inspection. But if you're working with Freddie Mac, FHLMC, they usually require a full appraisal using Form 1004. The income approach is all about how much money the property can make. This method is often used for rental properties. The appraiser takes the income the property generates and divides it by a capitalization rate, or cap rate, to estimate the property's value. The idea is that the more income a property can generate, the more it's worth. The cost approach is a bit different. Here, the appraiser figures out how much it would cost to rebuild the property from scratch and then adds the value of the land. They also subtract any depreciation, which is the loss in value due to wear and tear or age. This method is especially useful for new properties or unique buildings where there aren't many comps to compare. Let's go over some key terms you might hear in the appraisal world. Reconciliation is when the appraiser resolves any conflicts or inconsistencies in the data they've collected. An element is just a basic part of the appraisal process. Encroachment is when someone builds something that crosses over onto your property without permission. And ethical appraising means doing the appraisal fairly and honestly, following all the rules and guidelines. Now, let's talk about title reports. A title report shows the history of who has owned the property, kind of like a family tree for the house. One term you might see is subordination, which is when a lender agrees to let a new loan take priority over an existing one, usually to get better loan terms. An easement is when someone has the legal right to use part of your property for a specific purpose, like letting the city widen a street. It's different from encroachment, which is when someone uses your land without permission. Easements are authorized, while encroachments are not. Restrictive covenants are rules that control how a property can be developed, often to keep the neighborhood looking nice and property values high. Title insurance is a type of insurance that protects you from problems with the title, like mistakes in the records, fraud, or unpaid taxes. It covers issues that come up after the closing date. There are two main types of title insurance. Owner's title insurance is recommended because it protects you and your heirs for as long as you own the property, and it covers the full purchase price. Lender's title insurance is required and protects the lender until the mortgage is paid off, covering the loan amount. Both are important for making sure you're protected from any surprises with the property's title. Alright, let's talk about insurance. When you buy a home, there are a few types of insurance you need to know about: hazard insurance, also known as homeowner insurance, flood insurance, and mortgage insurance. Each one serves a different purpose, but they all help protect you and your lender from financial losses. Hazard insurance is what most people think of as homeowner insurance. It protects you against losses from things like fires or other disasters that could damage your property. The coverage is usually for the replacement cost of the home, meaning it covers what it would cost to rebuild your house, not just its market value. At closing, you need to have this insurance in place, and it should be set to renew automatically every year. If something happens and you need to make a claim, the lender is usually the loss payee, which means they get the insurance money. They have a couple of options: they can hold on to the funds until you rebuild, or they can use the money to pay down your loan. When you're getting insurance, you might hear about an insurance binder. This is a temporary document that proves you have insurance while you're waiting for the official policy to be issued. It includes all the important details like coverage limits, deductibles, fees, and terms. The declaration page is part of the insurance binder and contains all these details in one place. If your home is in a flood zone, you'll need flood insurance. The flood zone is determined by a flood hazard determination form. If you're in a high-risk area, this insurance is mandatory. There's also something called a mortgagee clause in the policy, which protects the lender's interest in the property. This clause sets up a separate contract between the insurance company and the lender. The National Flood Insurance Program, NFIP, was established after some big hurricanes caused a lot of damage in the Gulf of Mexico. FEMA, Federal Emergency Management Agency, plays a big role here. They identify floodplains, map them out, and educate the public about flood risks. The NFIP has limits on how much it will pay out, up to $250,000 for the property itself and $100,000 for personal property. The 1973 Flood Disaster Protection Act made it a requirement to have flood insurance if your property is in a special flood hazard area, SFHA. These are areas that have at least a 1% chance of flooding every year, also known as a 100-year flood zone. Flood zones are categorized by risk. High-risk zones, like A and B zones, require mandatory flood insurance. Moderate-risk zones, like B and X zones, make insurance optional. Low-risk zones, like C and X zones, don't require flood insurance, but it's still a good idea to have it. Mortgage insurance is a bit different. It protects the lender if you default on your loan. You usually need this if your down payment is less than 20% of the home's value. It's a way for lenders to feel more secure about lending to people with smaller down payments. Funding methods. When it comes to funding your loan, there are a couple of methods. Table funding is when a broker negotiates and closes the loan in their name, and then assigns the mortgage and note to an investor after closing. Warehouse funding is when a lender gets funds from a line of credit with a commercial bank to close the loan. Simultaneous title insurance. Simultaneous title insurance is when both the lender's and the homeowner's title insurance policies are issued at the same time. This can streamline the process and make sure everyone is protected right from the start. Debt service. Debt service is just a fancy term for the payments you make on your loan, which include both the principal and the interest. Even if you pay late fees, you're still required to make these payments. 360 of 180 loan. A 360/180 loan is a type of balloon mortgage. It's amortized over 30 years, but you have to make a big lump sum payment after 15 years. It's a bit of a hybrid between a traditional mortgage and a balloon loan. There are 5 key regulators in the banking world: the Federal Reserve Board, the Office of the Comptroller of the Currency, OCC, the FDIC, Federal Deposit Insurance Corporation, the National Credit Union Administration, NCUA, and the Consumer Financial Protection Bureau, CFPB. These organizations make sure banks and lenders are following the rules and treating customers fairly. Evaluating borrowers' creditworthiness. Finally, when lenders are deciding whether to give you a loan, they look at a few key factors: your creditworthiness, how good you are at paying back debts, your income stability, how steady your income is, and your ability to repay the loan based on their guidelines. These factors help them decide if you're a good risk for a loan. Congratulations on taking the next step toward becoming a certified mortgage loan officer. We hope this study guide has provided clarity and a solid foundation for your exam preparation. Remember, success comes with dedication and practice. Stay focused, keep reviewing, and you'll be well on your way to passing the MLO SAFE test. Good luck with your studies, And feel free to reach out if you have any further questions or need additional resources. Stay confident, and you've got this.